Good morning, everyone. Today we will be presenting a financial analysis of Sime Darby BERHAD, focusing on its performance over a 3 years period from 2021 to 2023. The purpose of this report to evaluate the company health by analyzing key financial metrics in four major areas: liquidity, efficiency, leverage, and profitability. This indicator will help us understand how well Sime Darby is managing its resources, whether it can meet short or long-term obligations, or how efficiently it's run its operations, and how profitable it has been over the year. This analysis will give us clearer picture of the company overall financial stability and operation performance during this period. Before we continue, I would like to introduce myself, AZRUL, and other teammates Arif, AIMAN, AFIQ, and Raja. Let's begin with a brief background of Sime Darby BERHAD. Established in 1910s, Sime Darby has evolved into one of Malaysia's largest and most respected multinational companies. It's publicly listed on Bursa Malaysia and operates across 17 countries and territories within the Asia Pacific regions. The company is mainly involved in the industrial and motor sectors, partnering with some of the world's most prestigious brands. Sime Darby is known for its strong focus on operational excellence, high performance standards, and corporate governance. Its commitment to delivering sustainable value to stakeholders continues to drive its growth and its global presence. Now, let's take a look at Sime Darby financial performance over the 3 years period from 2021 to 2023. Firstly, revenue showed a positive upward trend, increasing from 36.9 billion in 2021 to 45.1 billion in 2023. This indicates strong sales growth and expanding business activities. Net profit also improved, rising from 820 million to 1.35 billion. Although there were some fluctuations along the way, this reflects a general increase in profitability over the period. In terms of assets, the company saw a steady increase in total assets, growing from 22 billion to 24 billion, suggesting continued investment and access expansions. At the same time, total liability also increased from 12 billion to 13.2 billion, which is something we will explore further in our leverage analysis to see how it impacts financial stability. Graph 1.1 illustrates the current ratio of Sime Darby BERHAD over three financial years: 2021, 2022, and 2023. The current ratio measures the company's ability to pay off its short-term liabilities with its short-term asset. It's calculated using the formula current ratio equal current assets divides current liabilities. In 2021, the ratio was 1.38 times, indicating that for every 1 ringgit Malaysia of liability, Sime Darby had 1 ringgit 38 cent in current asset. In 2022, it slightly improved to 1.44 times, reflecting a stronger short-term liquidity. In 2023, the ratio was 1.43 times, it's showing a slight dip but still maintaining a healthy positions. Overall, these values suggest that Sime Darby has consistently maintained a strong liquidity position over the 3 years, staying above the commonly accepted safe benchmark of 1.0. This indicated the company is financially stable in meeting its short-term obligations.
Assalamualaikum and good day everyone. I am Arif SAFARUDIN bin Sane and I will now continue the presentation from AZRUL. Let's begin with the quick ratio, one of the key liquidity indicators. From the table, we can see that the quick ratio improved slightly from 1.03 times in financial year 2021 to 1.08 in financial year 2022, and then dipped a little to 1.06 in financial year 2023. What does this tell us? The quick ratio excludes inventory from current assets and measures the company's ability to meet short-term liability using only the most liquid assets. Since all 3 years show a ratio above 1, this means Sime Darby had more than enough liquid assets to cover its short-term obligations. However, the slight drop in 2023 suggests a minor decline in liquidity efficiency, possibly due to a small increase in current liabilities or slower conversion of receivable. In short, Sime Darby's liquidity remains strong, but the company should monitor its short-term asset management more closely. Moving on to profitability, let's look at the net profit margin. In financial year 2021, the margin was 2.22%. It decreased to 3.20% in 2022, which shows a significant improvement in profit generation. However, in financial year 2023, it slightly declined to 2.99%. Although the margin improved compared to 2021, this slight decline in 2023 may be due to higher operation costs or lower control over expenses. A margin under 3% still indicates that Sime Darby is operation on thin profit margins, which is typical in competitive or asset-heavy industries. This suggests that while the company is profitable, there's still room to improve its cost efficiency and perhaps optimize pricing strategies or reduce overheads. Overall, Sime Darby remains profitable, but the trend shows that maintaining or improving margins will require continued focus on operational excellence. Thank you.
Okay, thank you, Arif. Now, let's take a look at the company return on asset or ROA over the past 3 financial years for Sime Darby. So, in financial year 2021, the ROA or return on assets stood at 3.73%, which indicate a relatively modest return on the company total asset. However, in financial year 2022, we saw a significant improvement with ROA rising to 6.06%. This jump suggests that the company has substantially improved its efficiency in utilizing assets to generate a net income, a strong indicator of improved operational performance and asset management. Moving into financial year 2023, the ROA experienced a slight dip to 5.63%. While this is a marginally decline from the previous year, it is important to note that the figures still remain considerably higher than the 2021 financial year. This tells us that despite the slight drop, the company is still in a better position in terms of asset utilization compared to where it was 2 years ago. In summary, this upward trend from the 2021 to 2023, despite the minor dip in the latest year, reflect an overall improvement in the company's ability to convert its assets into profitable return. Maintaining or further improving this ratio should be a focus moving forward, as it directly impacts profitability and operational efficiency. So that's for return on asset. Okay, now next, let's focus on the company fixed asset turnover ratio, which measures how effectively the company is using its fixed assets such as property, plants, equipment to generate revenue. So in financial 2021, the fixed asset turnover was recorded at 4.10 times, meaning that for every ringgit invested in the fixed asset, the company generate 4 ringgit 10 cent in sale. This was a solid baseline. But in financial year 2022, we observed a strong improvement as the ratio increased to the 4.68 times. This increase signal efficiency in utilizing fixed asset possible due to better capacity utilization, streamlined operation, and or increased sale value without a proportional rise in a fixed asset investment. Financial year 2022 represent the peak performance in this area over the 3-year period. However, in financial year 2023, the ratio experienced a slight decline to 4.60 times. Although it is a minor drop from the previous year, it still indicates a strong level of efficiency. The company continues to generate a high volume of revenue from its asset, suggesting that overall asset management strategy remains effective. To put it into perspective, the fixed asset turnover in 2023 is still significantly higher than in 2021, indicating that the company has made sustainable improvement in how it leverages its capital investment for revenue generation. So going forward, maintaining the strong ratio or even enhancing it will be a key supporting long-term profitability, especially in capital-intensive industry where fixed asset play a critical role. So that is your 4 fixed asset turnover ratio. Okay, last but not least for my part, let's move on to the total asset turnover ratio, which is a key indicator how efficiently the company is utilizing of all its assets, both fixed and current, to generate revenue. So in financial year 2021, the total asset turnover stood at 1.68 times. This means the company generate 1.698 ringgit in sale for every ringgit invested in total asset. While this was a decent level of efficiency, there was a room for improvement. So in financial year 2022, the ratios improved significantly to 1.89 times, highlighting enhanced asset productivity across the board. This increase could reflect stronger sales performance, improved operational management, or better alignment between asset investment and revenue generation. So in financial year 2023, the ratio recorded at very slightly declined to 1.88 times. While this drop is minimal, just 0.01, it is worth nothing. It could be the due number of factors such as slowdown in revenue growth, a rise in total asset, or potential underutilization in certain areas. This minor dip might warrant closer examination to identify whether it is a short-term fluctuation of a sign of the trend. That said, the overall takeaway is a positive. The company has clearly improved its ability to generate revenue from its total asset base compared to financial year 2021. Both financial year 2022 and financial year 2023 level remains well above the 2021 baseline, suggesting that company is generally on the right track with its asset management strategy. Looking ahead, the focus should be sustaining or enhancing this ratio further by ensuring assets are effectively allocated, optimized, and aligned with the revenue generating activity. So that's all for me, Muhammad HAIKAL bin Muhammad Azmi. Now I will pass to the Muhammad AFIQ. Thank you.
Okay, thank you Aiman for the wonderful explanation. Okay, hi everyone, and now I will explain about the debt ratio of Sime Darby BERHAD for the financial years of 2021 until 2023. Debt ratio measures how much of the company's assets are financed using debt. It is calculated by dividing total liabilities by total assets. Based on the data, Sime Darby's debt ratio was 54.55% in 2021, slightly decreased to 54.46% in 2022, and increased again to 55% in 2023. This shows that more than half of the company's assets are consistently financed by debt across the 3 years, which indicates a moderate but stable level of financial risk. The slight increase in 2023 might suggest that the company is beginning to rely a bit more of debt financing. Even though the ratio is still under control, it is important for Sime Darby to monitor this trend closely to avoid future financial strain. Maintaining a balanced capital structure between debt and equity is important to ensure long-term sustainability and reduce financial risk. Now, let's look deeper at what this means for the company. Next is the debt to equity ratio. In 2021, the ratio stood at 120%, slightly dropping to 119.62% in 2022, before rising again to 122.22% in 2023. This means that Sime Darby is using more debt than equity to finance its asset. Although the changes are small, the upward trend in 2023 suggests that the company is becoming slightly more dependent on debt. This could increase financial risk in the long term if not managed carefully. For the conclusion, both ratios indicate a relatively stable but high leverage position. Going forward, it would be wise for the company to focus on reducing its reliance on debt to ensure financial sustainability. Thank you.
Hi, my name is Raja Muhammad Syakir. Okay, so now I would like to summarize the key financial ratios of Sime Darby BERHAD. Starting with liquidity ratios, the company maintained a stable position over 3 years. The current ratio stayed above 1.0, which shows that Sime Darby is capable of meeting its short-term liabilities. The quick ratio also improved slightly, indicating better management of liquid assets. Next, the profitability ratios. Profitability peaked in FY 2020 due to efficient operation and good cost control. However, there was a slight drop in FY 2023, which may be caused by higher costs or market challenges. For asset management ratio, the company shows strong utilization of both fees and total asset. This is supported by a higher return on asset and good net margins, especially in FY 2020. Lastly, on leverage ratio, although the debt to equity trend remains stable, it is slowly increased. This could be a concern for long-term financial sustainability if not properly managed. Okay, we move to the next part. Okay, so based on financial analysis, here are the few recommendations for Sime Darby moving forward. First, the company should continue to monitor and control operational costs to protect profit margin, especially as profitability slightly declined in FY 2020. Second, it's important to focus on boosting revenue through better marketing, innovation, or expanding into new markets, while also maintaining cost efficiency. The third is Sime Darby should reduce its reliance on debt. Although the leverage is still stable, the upward trend could pose risk in the long run if not addressed. Lastly is the company is encouraged to strengthen equity by increasing retained earnings or attracting new investment to support sustainable growth. That's all for me. Thank you.